something massive is happening behind closed doors. Major banks are quietly shifting billions of dollars into gold, and no one in mainstream media is talking about it. Why now? What do they know that we don't? According to several verified reports, central banks and major private institutions have been increasing their gold reserves at the fastest pace since 1971, the very year the U.S. abandoned the gold standard. This isn't random. It's part of a larger move known inside financial circles as the debasement trade. This strategy signals one thing. The world's biggest money players are preparing for a long-term decline in the dollar's real value. They're not selling all their dollars, but they're quietly repositioning their assets before a major reset hits the system. If you think this sounds dramatic, stay with me, because in today's video, we'll break down what's really happening, who's behind this move, and how it might affect your savings, investments, and even your country's currency in the next 12 months. Before we dive in, make sure you subscribe to the channel, like this video, and share it with anyone who follows global finance or geopolitics. Every day, we bring you insider-style updates that the mainstream won't cover. Stories about currency revaluations, central bank leaks, and global shifts that could change how the financial system works. Now here's what we're covering in this report. First, we'll expose why major banks are loading up on gold and what internal memos reveal about their long-term strategy. Then, we'll analyze how this connects to the ongoing weakness in the US dollar and why some insiders are calling it controlled debasement. Next, we'll show evidence and data from official bank filings that prove this shift isn't rumor. It's already happening. Finally, we'll discuss how this could reshape global markets and what small investors can learn from the moves of the big players. Let's start with what the banks are doing, and why they're doing it now. Over the past year, the pattern has become impossible to ignore. From J.P. Morgan to Deutsche Bank, from the People's Bank of China to the Bank of Russia, the largest players in global finance are quietly increasing their exposure to gold. Publicly, they call it portfolio diversification. Privately, it's about protection. Protection from what? From a slow, managed erosion of the dollar's purchasing power, the controlled debasement that insiders have been whispering about since mid-2024. Let's break it down. Every time the U.S. government increases spending without matching revenue, the Federal Reserve indirectly absorbs the cost through liquidity injections, new money entering the system. That means more dollars chasing the same goods, and over time, each dollar buys a little less. For average consumers, that looks like inflation. For big banks and central institutions, it looks like an opportunity. They know the rules of the game. When currency weakens, real assets rise. That's why the shift into gold isn't random. It's strategic. Recent IMF data shows global central bank gold purchases hit a record 1,100 tons in 2024, and the trend is accelerating in 2025. China alone added over 200 tons in the first half of this year. Even Western banks, which historically avoided gold since the 1990s, are now hedging with physical holdings and gold-backed instruments. The question is, why now? Because the global system is quietly preparing for a reset of trust. After 2 decades of debt expansion, currency manipulation, and geopolitical tension, confidence in fiat money is fading. You can print more dollars, euros, or yen, but you can't print gold. That's the essence of the debasement trade. Insiders aren't betting on chaos. They're betting on math. They see the long-term imbalance between printed money and tangible assets, and they're moving before that gap becomes impossible to hide. Up next, we'll dig into the evidence, leaked reports, trade data, and banking disclosures that prove this shift isn't speculation. It's already happening beneath the surface. Let's look at the hard evidence. When you follow the data trail, it becomes clear. This isn't a rumor. It's policy in motion. Start with official numbers. The World Gold Council confirmed that central banks purchased more gold in 2024 than in any year since records began, surpassing even the buying frenzy of the 1960s. In the first 6 months of 2025, Over 900 tons have already been added to reserves. That's a 22% increase year over year. But it's not just central banks. Private institutions are quietly aligning with the same playbook. According to recent filings, J.P. Morgan Chase, HSBC, and Goldman Sachs have expanded their gold-backed asset divisions. J.P. Morgan even opened a new storage facility in Singapore, designed specifically for institutional clients moving assets out of dollars. Meanwhile, data from SWIFT shows that international transactions settled in U.S. dollars have dropped from 85% to 76% in the past 2 years. That means cross-border payments are slowly diversifying into euros, yuan, and gold-linked instruments. Then there's the most revealing clue: insider memos. A confidential report circulated among European financial institutions in August 2025 warned of a potential currency credibility crisis if inflation in major economies remains sticky above 4%. The document specifically mentioned a measured transfer of reserves toward tangible assets, a phrase analysts interpret as coded language for gold accumulation. At the same time, BRICS nations continue testing a commodity-backed payment system that bypasses the dollar entirely. Leaked drafts from early 2025 describe a hybrid settlement model pegged partially to gold and partially to energy exports. So what does all this tell us? That the shift isn't random or reactionary. It's coordinated, not necessarily by conspiracy, but by shared incentives. Banks and states alike are protecting themselves against the same long-term threat: a gradual loss of faith in fiat money. In short, the world's financial elite are repositioning quietly while the public debates politics and interest rates. And that brings us to the next question. What happens when this silent repositioning becomes visible? When markets finally react? That's where we're headed next. If this pattern continues, the implications are enormous. We're not just talking about short-term volatility. We're talking about a slow, structural shift in how global wealth is stored and transferred. First, let's look at the US dollar. For nearly 8 decades, it has been the world's reserve currency, the anchor for trade, oil, and debt. But when major players start moving even a small percentage of their reserves out of dollars, it sends a signal. It tells the market, the age of absolute dollar dominance is fading. Right now, the dollar index still looks strong on paper, but the strength is deceptive. It's being held up by short-term interest rate differentials, not by long-term trust. Once those rates start to fall, which they will as global economies slow, capital will flow away from the dollar faster than it came in. Next, the gold market. Gold isn't just a hedge anymore. It's becoming a silent currency. When central banks buy gold, they're not speculating on price. They're preparing for a settlement mechanism, a world where real assets back at least part of financial transactions again. Analysts from multiple research desks have quietly started modeling a dual-tier system, where fiat remains for local use, but cross-border settlements increasingly rely on gold or commodity-linked assets. That's the modern version of a partial gold standard. Now think about what that means for investors and ordinary savers. If major institutions are diversifying quietly, holding only paper assets becomes riskier over time. Inflation will not explode overnight, but it will erode consistently, year after year. Meanwhile, gold and other hard assets could rise not just because of demand, but because of revaluation. If currencies weaken globally, the same ounce of gold naturally becomes more valuable in nominal terms. So the forecast is clear. We're entering a period of monetary realignment, not chaos, but recalibration. A phase where value slowly migrates from paper promises to tangible assets. And the smartest players are already in position. In the final part, we'll break down what this means for you, and how to stay ahead while the rest of the world wakes up to this shift. So, what does all this mean for you? It means the financial system you grew up with is already changing, quietly, steadily, and without public announcement. While the headlines talk about elections, debt ceilings, and GDP numbers, The real story is playing out in the balance sheets of global banks and the vaults of central institutions. The world's biggest players are preparing for a softer dollar, a harder store of value, and a future where trust will once again depend on what you can actually hold, not just what's printed. This is the heart of the debasement trade. It's not panic, it's positioning. The same institutions that helped create the modern dollar system are now hedging against its long-term decline. For you, the lesson is simple. Follow the quiet moves, not the loud narratives. When central banks buy gold, they're sending a signal. When major financial houses open new vaults and storage facilities, that's not coincidence. That's preparation. And when insiders start talking about tangible collateral and real value backing, it's not speculation. It's strategy. The global monetary reset won't happen overnight. It will happen gradually, one trade at a time, one policy at a time, until one day the world wakes up and realizes the foundation has shifted. Those who paid attention early will already be protected. Those who didn't will be forced to adapt. That's why we cover these stories every day. Not to create fear, but to help you see what's really happening behind the curtain. So if you found this analysis useful, subscribe now and turn on notifications. We bring you daily insider updates on global currencies, central bank actions, and geopolitical financial moves that mainstream outlets ignore. And remember, knowledge isn't just power, it's protection. Stay informed, stay prepared, and stay ahead of the curve. I'm Host Name, and this is Global Currency Watch. Thanks for watching, and I'll see you in the next report.